Good day, fellow investors. Intrinsic value, how to calculate it, the definition, a free Excel template, 10 stock examples, and a comparison. I really think that now is the time, 2025, to learn what's the difference between value and price. We're going to use this template. You can download it in the link in the description below. And then we can also create a comparative table of the 10, 12 stocks that we will analyze. This will be filled, not yet to look at. Let's immediately start with what is intrinsic value and my assistant that has the best definition of it.
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those. Number two.
So you got formulas involved in finding intrinsic values on certain companies. I mean, you've got a mathematical system set up.
Discounted present value of future cash, yeah.
Okay.
Thanks, Warren. Great definition. Let's now start with the intrinsic value definition and exact formula so that we can apply what Warren Buffett shared. As Warren said, print out what the stock will pay out in the future from today to Judgment Day. Print out what the stock will pay out. And the stock will make that payment in cash sooner or later, or as he says for Berkshire, that we'll discuss also, the potential cash payout is also what counts. How does Warren say it? How much, when, and how sure we are that we're going to get the cash. The definition: discounted present value of future cash flows. And this is the formula. You have the future value and then discounted at, depending on the year, when the year is in the future, to bring it to the present value. The sum of those present value is the intrinsic value of a business. You'll have all of this in the template without the fancy mathematics. But here we come to the first issue. We need to estimate the future potential cash payments. Estimate the future. And that's the key. My crystal ball broke last month when my kid was playing with it, so I'm having some trouble. But we can start with bonds. With a bond, it's very easy to calculate. Of course, if it doesn't go bankrupt, then you're in trouble. But you have the purchase, you have the annual or semi-annual coupon payments, and then at the last day you get the coupon payment and back your principal. So that's easy, but that's something also that we have to put into stocks, as Warren Buffett said. How to put that into stocks? We need to calculate potential dividends, earnings, free cash flows, growth, the business cycle, market panics, exuberant situations, shocks that are always around, business risks. And yes, that is a lot, but the key is to know the business. When you start knowing the business, then it is much easier to also calculate the intrinsic value and fill the template I'll show you here, because then you know what goes where, how the business will likely evolve over time, and you can download this free template here on my stock market value investing course, all free there. The whole course is for free, so no worries. And then we'll go through the individual inputs to help you understand how to calculate intrinsic value, and you'll see the more you know a business, the easier it will be for you to put in these parameters to give you an intrinsic value that you can then compare to the stock price and understand whether that is a good investment for you or not. We are going to start with Apple as the key core example because it is the largest company of the S&P 500 and likely also the most known company out there, but also the most easier to understand. And let's immediately start with the first input on our table, which is the value creation or current or future potential cash payout, as Warren Buffett says. Now, we have price earnings ratio, earnings, dividend yield. What are we going to use to put here the input, the value creation, the future or current potential cash that the company is paying out? Warren Buffett prefers to use owner's earnings, and owner's earnings are the value the business is creating for the owner, you as a shareholder. The only way to exactly measure owner's earnings is to check the change in book value over the year plus the dividend. But when it comes to owner's earnings, again, I have to emphasize, it comes to understanding the business, how the business creates the value now, and how it will create the value in the future. When you start understanding that, then you can also know how to calculate intrinsic value. And even Warren Buffett says that 95% of the businesses out there, he cannot calculate intrinsic value because he puts them in the too hard pile. And let's now look at Apple's financial statements. We have net income here, last year, fiscal year, 94 billion. We have something very important, stock-based compensation, which are the stocks that Apple gives to management. And we then have, when everything is deducted, the accounting cash flows from operations, 118 minus capital expenditure would give you the free cash flow from an accounting perspective, 109 billion, and many use that as the value creation per year. I'm looking at how much Apple does spend, and they do spend 100 billion on buybacks and 15 billion on dividends for 115 billion, less or more, and here are the free cash flows. However, I would personally also deduct this 12 billion as stock compensation because Apple is repurchasing common stocks to then issue those same stocks to management. Thus, I would lower this number by the stock-based compensation, which then doesn't put the free cash flow to 108, but it lowers it to 96 billion. And if I look at my 96 billion and compare it to the net income generally accepted accounting principles is a pretty fair and good representation of Apple's earnings. It has been for the last 10 years since I'm following Apple, so we can use that. When it comes to intrinsic value, Warren Buffett says it very clearly. I know I'm going to be precisely wrong, because it's impossible to know the future. But what we want to be as investors is vaguely right. I don't know whether Apple is going to be a 2 or 5x in the next 10 years. But if I know that's going to be a 2x or a 5x, that's okay from an investing perspective on being vaguely right. If it's going to drop 50% in the next 10 years, then you avoid it, but whatever happens, happens. That's the risk and reward. So we are trying to be vaguely right for all of those that are already blocked when creating inputs. Another thing to discuss here is what kind of input do we put? Do we use per share value or the market capitalization? Again, it depends on the business, but as Apple is doing a lot of buybacks increase the growth rate of earnings per share because the number of shares is going down, so it's better to use a per share value for Apple. And now let's go to our template. So this is the start of the template. Here are the stocks. You simply click here and it jumps to the sheet there. Now, when it comes to Apple, I have already put in here 6.08 in earnings per share, and now we know, okay, that is the calculation for Apple, and that's the first input. Then I have put here 10 years of forward estimation, and then we'll discuss also later, I want to sell it at the end of the 10-year period. So we have put in the earnings, and now we have to calculate, okay, how much are those earnings going to grow over the next 5 and 10 years? Thus, the growth rate estimation. How much will Apple grow? How much will the value creation grow over the next decade? For that, again, we need to understand the business. We go to the investor relationship page, you follow it for years, and that's also why it's nice to have a table of this, like 20, 30, 40 covered stocks, even 20 is enough, and then you simply wait for the ratio here to be 1 or higher. That gives you a positive risk and reward return, and if you follow 20 stocks, I can guarantee you that 1 per year will hit those levels, and that's why it's nice to have a list like this. Let's see now where is Apple's intrinsic value and future growth. The future growth is based on Apple Intelligent Products, then also services revenue that keeps on growing very fast, and then iPhone and all the other gadgets, computers are still going strong. But if I look at the revenues have been relatively flat for already a few years, and also net income has been flat since 2021. Flat for already a few years, and that's not something little when it comes to a big business like Apple. But that was the past. The key question is how much will it grow further? And we can now discuss Apple Intelligence, services, this or that. But I remember also 2016, I analyzed Apple, and the key there was that Apple was not going to grow at all, and the P ratio was 10 compared to the S&P 500 of 20. This was in March 30, 2016. I rated it as a buy, and since then the stock did pretty well. Okay, now we have to estimate the future growth rate of Apple for the next 5 years. But before going to the growth rate, we also need to calculate the impact of buybacks on earnings per share growth here. And here we have Apple revenues that haven't been growing lately, and net income also hasn't been growing. But if we look at earnings per share over the same period, those have been growing at a slow pace. But if we look at how much money does Apple spend on that growth, on that buyback yield, we have 100 billion spent minus the stock-based compensation, that's around 90 billion. And with buybacks of 90 billion, you have to compare that to the market capitalization to get the buyback yield. If I do that, 90 billion compared to 3.5 trillion market capitalization, I get to a buyback yield of 2.5%, which is the reason why I think Warren Buffett sold, because in each of his last 5 letters, he commented on buybacks being good when the price is right and being value destructive when the price is wrong. At current levels, at a P ratio of 40 with no growth in sight, I think that's the reason why Warren Buffett sold Apple. But okay, Apple Intelligence buybacks inflation, there can be various scenarios. And that's also why I have put scenario 1, scenario 2, and scenario 3 here. And then when you calculate the various intrinsic values for each scenario, you can put here the probability, and then depending on those probabilities, you get the intrinsic value for the company. Now, when it comes to probabilities and scenarios, I think it's a good mind effort to see, okay, what can happen good? Everyone is so focused on returns, but that's why also we have here a worst case scenario, so that you focus on what can be the worst situation possible for my investment. Value investing, what we do here on this channel, is about investing and finding investments that even in the worst case scenario do well for you. That's the uncertainty but low risk. I don't know whether a stock will do 2x or 5x in the next 10 years, but if all goes wrong and it does 2x or just pays the dividend of 5, 6, 7%, I'm okay as an investor. That's value investing. That's why also the scenarios here for a good, let's say, thinking rationale when it comes to stocks, not just rewards but also risks. So let's finally put this growth rate here per scenario. First we have the normal case. Okay, what's going to be the normal case growth going forward? We have 2.5% on buybacks that Apple is spending. Keep in mind, if Apple doesn't make the same profits, then the buybacks will go lower, but let's estimate that in normal case scenario that will not happen. We have a few percentage points of inflation, and I would say, let's say that Apple grows 6% per year, perhaps some declines here and there in a normal situation, recession, you never know, we are at 6. The best case scenario now, well, if Apple manages to develop intelligence, more services, we can leave the growth rate at 10%. And then the worst case scenario would be a situation where Apple doesn't grow at all, let's say for 5 years, and then we have slow or sluggish growth. Now, as I've discussed in this article here, at that time, in 2016, nobody liked Apple, nobody was projecting growth or whatever, they just were saying it was just a hardware phone company. And that's exactly what makes also the market perception to be implemented in these scenarios. Because maybe if we discuss the worst case scenario, maybe it will happen just once in the next 10 years. But you know what could be the bottom if the market starts hating Apple, and that also then represents, okay, this is the worst case scenario, a margin of safety for the stock. Now that we have estimated the future growth rate for earnings in various scenarios, now we have to calculate the present value of those future value creations for us as a shareholder. To do that, we have the present value and discount rate that have to be calculated in order to get to intrinsic values. Plus, we have to ask ourselves how much of that yearly value creation is for us as shareholders, which the only way a company is paying you is a dividend for that yearly value creation. Of course, if the value creation increases the potential in the future, then when you sell, you get a better price. But that's already included in the growth rate. So we must not count the present value of Apple's free cash flows and the growth rate twice. That's a problem that I often see with intrinsic value calculations. So first we have here the discount rate that we'll be discussing in a moment. I usually put 10% and I'll explain that later. Now, on the present value of the future cash flows, we have 6.44 likely earnings on the 6% growth going forward, but I have put here this, which is the dividend payout ratio, and then I have calculated here the present value. This would be the full present value, but as Apple pays out 16% of the value creation of net income in dividends, then this is the only present value that the cash that I'm getting as a shareholder over time, and then those present values are summed up in the intrinsic value. Plus, if I decide to sell in 10 years, then I have the terminal value that is then also discounted at the discount rate that we use here. So here we have the net income that we have discussed, and just 15 billion of that is paid as dividends. That's just 16% of a payout ratio that I have inserted here. Now, when it comes to the discount rate that is then applied to all the scenarios, I always use 10% to keep things simple, because 10% is my, let's say, required investment return, and then by using always the same rate, I can compare all the other investments at the same rate. Usually, risk-reward free rate, the 10-year treasury can be used. Then Buffett says to use the proper discount rate. He never discusses what he uses as a discount rate, but Charlie Munger used to say that they target investment with 8 to 10% returns over the last few years, given their size. So I'm also thinking that Buffett uses 8 or 10%, not the treasury or some other variable rate. Then there is also something discussed where the higher risk, the higher should be the discount rate. As value investors, if there is higher risks, first, we don't take that investment, you put it to the too hard pile, but you can then also change the probabilities in the scenarios that then also reflect that risk going forward. So again, don't count things twice. And if I look at the treasury, if I look at, it was 3% the 10-year treasury, then it was 1, and now it is almost 5. So suddenly here Apple would be worth X, here it would be worth 4x, and here it would be worth 0.5x. Then there is always the expectations that rates will go lower, but okay, for me it's about comparing investments. I don't care about academia, I care about making good returns so that I reach my financial goals. Now, to calculate easier, I take a 10-year frame because I think it is enough to explain a business cycle, and then let's put a terminal value and sell Apple in 10 years. Alright, let's do the terminal value here and the terminal multiple that we need to determine the terminal value. Now, when it comes to the terminal multiple, I calculate the P ratio that I estimate will be there 10 years from now. When it comes to P ratios, it's very hard to find the P ratio, what will be the P ratio 10 years, but it's just a P ratio estimated down the road. The lower it is, the more conservative you are as an investor. So if there is upside from valuation expansion, that's always a benefit. 15 has been the historical average of the P ratio for the S&P 500, 7 to 25, even 30 now. And things change a lot in 10 years. That's something we have to understand. Apple was hated 10 years ago, now it is loved. A few years again it was hated, then it will have these ups and downs. And if we look at the top companies of the S&P 500 15 years ago, then it was Exxon, Apple was there, Nvidia was nowhere, Microsoft was there, GE is now nowhere, Google wasn't even close, Chevron, okay, IBM also then had a leading valuation. Now those businesses are not really there anymore, and new businesses have come and taken those places. So that's also something to keep in mind when we invest for the long term. Now, to keep things conservatively, okay, in a normal case scenario, we can put 15 for the valuation multiple. That 15 is then used with the 2023 earnings time 15, give you the terminal value here. You can see it here. Why 2023 earnings, not 2034? Because in 2034 I will not have 2034 earnings, I will have 2033 earnings. So that gives me a terminal value that I then discount to the present value, and the sum of all these present values is the cash flows I'm getting as an investor. And with these estimates, the intrinsic value of Apple is 67, and we can compare that to the stock price. I forgot to do that. Let me just do that quickly. Here it is. It is updated automatically when you refresh the Excel, as I have put here a lot of in my Google Sheet. If you want to copy it and put new stocks, you just create a Google Sheet for you and delete the sheets you don't need, and we'll discuss all these stocks as we are going forward. But here we are with Apple, and that would be the valuation in such a scenario. Let's see what's Apple worth in the best case scenario, or what I like to do is to put here, okay, what is priced in the business now? If I use a discount rate of 10%, terminal value of 40, then that's exactly it. 10% growth rate in earnings, 10% discount rate, 40% terminal multiple, and the present value sum explains the current stock price. Perhaps they are using a 5%, let's say, discount rate to compare it to the 10-year treasury, and a lower growth rate, I don't know, perhaps 8%, but that's something you can play around in time, and then a 30 long-term terminal multiple, and that's again it. But just to be a value investor and to stay a value investor, let's put here a multiple of 30, and even in my best case scenario, Apple stock is now overvalued. Worst case scenario, margin of safety 0, 2% discount rate, terminal multiple, let's put 12, not to angry people, and my present value sum, margin of safety, in the worst case scenario is a stock price of 36. If we put 60, 20, 20 for the scenarios probabilities, the sum of things, the intrinsic value is a big 82 for Apple. We go to the comparative table, you can also click here, and Apple price 10% return, it's a ratio of 0.35, which is a disastrous ratio. And that explains why Warren Buffett sold. Maybe he's using my template, I don't know. If you're using it, Warren, let me know in the comments. But let's focus on the intrinsic value calculation, and this explains what are the moving factors, what is priced in the stock, will it happen, will it not happen, thus it gives you a better perspective on the risks out there. Of course, there are also deficiencies of intrinsic value. It's a calculation that we made now in January 2025. It's pretty fixed, and as we have seen, businesses change for the better or for the worse. There is always the debate over the discount rate. Should it be 4, 5, 10? Should it be 15? You never know. But 8 to 10, Warren Buffett uses. Miners that need more stability use it. So that's a discount rate that I feel comfortable, 10% for me, and I solved all the debate around the discount rate. The growth rates, impossible to estimate. And now in this environment, everyone estimates huge growth rates for all the Magnificent Seven companies, but usually historically that hasn't happened. And this again is just an indication that can help you in knowing and valuing the risk and reward of investing in a business. Let's now go to intrinsic value examples. Let's take 10 from our value investing quadrant and then discuss. And first, I want to start with the S&P 500 index. And by discussing all these stocks, I think that if you follow, each company is different, each business is different, you will really get a grasp or how to use the intrinsic value quadrant. You can also download it and do the exercises yourself, and then you can compare it to my calculations here. Let's immediately start with the S&P 500. 5,827 points. The current P ratio is 30, which is among the highest historical P ratios. And then I look at the earnings, which is the value creation per year. And the earnings, let's put them at 200 for the last reported quarter that we have all the data, are close to 200. And here you immediately see something. Earnings, this is adjusted for inflation, but okay, haven't had stellar growth. Actually, those are down from 2021. That's something to keep in mind. Then we have the dividend. What is the value paid to us? The point dividend is 75 compared to the earnings. That's, let's say, a 40% payout ratio. Let's now go to the S&P 500 template and do this together so that you can see how it works. Dividend payout ratio, here we said 40%. We put the input earnings per share of the S&P 500, 200, and now growth rate of the earnings, I would put 5%. That's the normal historical growth rate of the earnings of the dividends. I expect a 10% discount rate, a 10% return. Those are my calculations. And then if in 10 years I put a terminal multiple of 15, then I get to an intrinsic value of 2,000 points for the S&P 500. And I know you will call me crazy, that's more than 50% down, but that's for me a present value, a fair present value for the market. Everything else is betting on higher terminal multiples. And let's go to the best case scenario to explain, okay, what is priced in the market now? So the earnings are here replicated from the previous scenario. Then we can take 10% growth rates and a 30 terminal multiple here, and that explains the S&P 500. The current estimation from Wall Street is for earnings to grow at 10% forever for the S&P 500. Warren Buffett says when you estimate earnings will grow higher than 7%, you get in trouble. 10%, discount rate 10, and a P ratio 30 forever for the S&P 500. That's the best case scenario. But let's go to a margin of safety, worst case scenario. Let's say that we have 2 recessions in the next 10 years and that earnings grow just 4%, buybacks go down, the discount rate 10, and we get to a crazy, because of higher interest rates, terminal multiple of 10. That has also happened in the past. And then the present value of the S&P 500 is 1,692. Let's put the probabilities here in check. And what's the probability of the normal case? For me, I think the normal case can happen in 40% of situations. The best case, very unlikely, but we are in a crazy world. So let's put 30 and 30. And the present value for our S&P 500, expecting a 10% return, would be 3,351. Of course, if I change the discount rate here from 10 to 5%, then we are immediately at 5,000 points for a fair value of the S&P if you expect a 5% return going forward. But let me put to 10. Let's go to the comparative table. S&P 500, And it is better than Apple because of the lower P/E ratio for similar likely growth, but still overvalued. And I know this is crazy, but we are now in a crazy environment, and that's exactly why I'm discussing the intrinsic value, so that you invest only when you find something that fits your intrinsic value. If you expect 5% per year going forward, growth plus inflation over the very long term, 20 years, then the S&P 500 will deliver that most likely sooner or later. But if the risk materialize, if people stop liking it as they like it now, then it can also be down 50-60%. That's a possibility, and that's why we have these calculations. Alright, let's do some more stocks. We have here the VanEck, gold, we have recently discussed Amazon. So let's start with the VanEck Gold Miners ETF here. I have checked the dividend yield there, 1.12%. Compare that to the stock price here, and let's calculate the VanEck intrinsic value then. VanEck, we click here, we put here dividend per share 0.4 in my calculations, and the growth there depends on gold prices, but miners haven't shown much growth because of the wrong things that they do over time. If I expect a 10% discount rate, which is the minimum from miners, the dividend payout ratio is 100% here because I'm calculating dividend per share, 5% growth going forward, and now here we have to use a terminal multiple that reflects the dividend payment. So dividend payment, if I want 2%, 100 divided by 2, then the terminal multiple must be 50. If I want a 4% dividend, then the terminal multiple is 25. If I want a 5%, then there is 20. Let's put that a fair yield from miners should be 3%. That's a terminal multiple of 33. The intrinsic value now of the VanEck is $11 compared to the stock price of 35. Call me crazy, I know, but it is what it is. If we look at the best case scenario, then let's say they grow the dividend on some miracle 10%, the discount rate still 10%, okay, and the terminal multiple, let's say the dividend yield requires just 50, then we are somewhere at 22, still exuberant. If the dividend required is 1%, then that explains the current price because the yield there required is minimum. Worst case scenario, gold prices go down, there is no growth rate, discount rate 10% from expected returns, terminal multiple, let's put 20 just to be positive, and the price there, the present value sum, is just 5.54 for that index. Of course, this is a gold investment, and that also people look at it from a different perspective. The value of the gold in the ground doesn't matter when it will be paid out, but the value is in the gold there. The potential for the future, the defense against inflation, and that is also one of the deficiencies of the intrinsic value. A lot of those things that people invest for are not here into. But in general, gold miners, as we discussed in the video, are a little bit expensive. And if we go to our comparative table here, you have here the gold miner video and all the links to all the other videos that we discussed, and those will also be in the description of the video here. Next business, let's discuss Amazon. We have just recently discussed it quickly, and we have set up, let's say, a growth rate of 8% going forward on the net income of 50 billion there. That will grow to, let's say, 107 billion in the future. And let's put that into the template. We go to Amazon, and now the key thing here is let's put the right income, net income in billions, 50, growth rate 8%, discount rate, and then terminal multiple. Okay, if Amazon keeps on growing, let's put 20. So 20 for the business. The dividend payout ratio here is 0, so no present values here until you sell it, And then when you sell it, the intrinsic value, here I have used billions, so we have to compare it to the market capitalization if I use it here. So I have to change here market capitalization and then also change the input there from the table I have here. Let me just find it. Amazon, here is the billions. Let's just put it as a number, and let's also divide it by how much? 1 billion for comparative reasons. So we have 2.3 trillion, net income in billions, 770 billion on this returns. So it was close to it when I made a video 2 years ago and saying it was a buy. Now it is pretty far from it. But let's go to the best case scenario. Let's put 12% growth rate for the next 10 years, discount rate of 10, multiple of 40, and that then explains the current stock price or market capitalization. So sometimes you can use stock price, sometimes market cap, depending what you like mostly. As Warren Buffett said at the beginning, he likes to think in market caps because he likes to buy businesses. Worst case scenario, margin of safety, let's say, okay, 6% growth rate, discount rate 10%, and just a 15 P ratio, then you get to $500 billion of 500 billion valuation. Let's put here some kind of probabilities. I don't know, it's just for an exercise, mental exercise. 40, 30, let's put 40 on the best case because I think Amazon will grow for sure. And let's put just 20. So a fair price for a 10% return is 1.2 trillion for Amazon. If we compare that here, just have to change the stock price into the market cap for Amazon, and here we have it. It is still pretty much expensive from this comparison. And as I think Amazon is a little bit expensive for my taste, on my Amazon video there were these great comments how revenue growth of 8 to 10% next 10 years per year, 15 to 20% earnings growth with margin expansion. 15 to 20% means that earnings will grow double every 3.6 years, which means in 4 years we are at 100, 200, and then likely the end of year 10, 250 billion in earnings. That would be half the current revenue. So I see a lot of exuberance in the market. It might happen. I wish for that 5 to 8 trillion market cap. Okay, go for it. And many comments like that. P ratio of 20 on company that has unlimited potential revenue streams. Value investing is not about potential. It is about cash, as would Warren Buffett say. You are completely missing the expected earnings growth. Also, okay, why you sold it didn't work on that portfolio anymore. But when it comes to here, I find it very, let's say, expensive, but anything can happen. And when it comes to stock prices, I find it always peculiar when a stock price goes down, like Amazon 2 years ago, everyone was afraid of this or that. Now when the stock price is very high, the projections for the future become very exuberant. And that's also then makes it very difficult to calculate and to agree on intrinsic value because we are all different. Let's go to the US 10-year treasury, let's do McDonald's, then go to Nestle. So I have not put it in the comparative table, but I have done just for the exercise the 10-year treasury to see how would that be in the table and valuation, what to expect. 4.6 is the yield. I have used the terminal multiple of 21.75 just to get to 100 here. The growth rate, has to be 0. You invest 100 now, you get 100 back. The discount rate, of course, cannot be 10% because you know what your return will be, and the intrinsic value is 100. So that is how easy it is to calculate the coupons on the bond. The present value for the discount rate of 4.6%, this is rounded up here. Here you have the discount rate. And that's just a quick example of the 10-year treasury. Unlikely the government will not pay you, there can be inflation, but you will always get your $100. What will those $100 purchase? That's a different question. Then we have McDonald's, dividend yield 2.5%, $7.8 dividend per share. Here is McDonald's. I have also inserted the dividend per share. They estimate for good growth going forward, let's say 5% growth. And then what is the expected dividend? 2.5, so terminal multiple 40. If I divide 100 with 2.5, let's say 40, and then it gets you to the intrinsic value of 224. So close, not that far from the stock price. If they manage to grow the dividend, the payout ratio, of course, 100%, you can get a 10% rate return if the dividend remains at 2.5%. If the dividend goes to 4% because of higher interest rates, but the growth still is there, then the intrinsic value is already much lower. Best case scenario, let's say the market wants a 2% dividend yield, 5% growth, and then that is what the market is expecting now. So lower rates and therefore very risky in my perspective. Margin of safety, 4% growth for McDonald's, and then let's say a 5% dividend yield, terminal multiple for the dividend of 20, and you have a present value of 130, which is 50% down. If we put a normal case scenario to 40, 30, 30, we get to a present value of 183. Compared to the stock price, it is, again, let's say not that expensive, but still expensive. If we go to the comparative table, McDonald's is the best priced on the stocks that we have discussed till now. Alright, we have then Nestle, we have the input here, 3 Swiss francs for a dividend, higher dividend yield, which will make it also interesting to compare to others. Let's immediately also take Nike here. We have there, again, another dividend input here for me on a lower dividend yield, and we can also use DHL, the German Post, that has a bit higher dividend yield and a dividend yield of 1.84 euros in this case, to be compared to the stock price. Perhaps another dividend comparison, the Schwab US Dividend Equity ETF. So let's do this for dividend stocks analysis and see what the risk and reward is. So Nike, I have already included here the dividend per share of 1.6. Now their target is to grow the dividend, keep on growing as they did for the last 30 years with Michael Jordan at 10%, but the growth isn't there, so let's be a bit more conservative and say 5%. The terminal multiple, now the dividend yield is very low, but I think given the size of the business, the market will require a 3%, 3.3% dividend, let's say 3% dividend. Terminal multiple of 33, the intrinsic value of Nike there is 44. If we go to the best case scenario, they managed to grow at 8% with their standard ups and downs, and the market gives it a multiple, let's say, of 40, then that explains what the market is still pricing in now, pretty positive for Nike. But we need to reach that growth rate, and then again the stock is overpriced from that perspective. But keep in mind, this is for a 10% return. If you want a lower return, then that's it. For 8% growth, 8% discount rate, 2 point something dividend, and then you have the current stock price, even Nike as undervalued. But if you want a 10% return, then that's a different story. So that's always something to keep in mind with what I do. 4% growth rate, discount, and then let's put a 4% dividend yield, not to piss too many off, then the present value is still another 50% down. Probabilities, let's say stock price is still a little bit overvalued compared to the stock price. If we go to Europe, DHL, Deutsche Post, the dividend yield is already 5%, so that's a little bit different. So the terminal multiple now is even lower than 20. 100 divided by 5.5, it's 17. They expect to grow alongside the e-commerce market and this, but let's put 6% growth going forward, discount rate of 10%, and here you have it. This is then fairly valued if they can reach the growth there and grow year by year over the next 10 years. The best case scenario would be faster growth, let's say 8%. Let's say the market revalues them and wants just a 4% dividend. 100 divided by 4 is 25. Then the stock is severely undervalued from that perspective. If we go to a worst case scenario, let's see if there is a margin of safety, 0% growth. Let's say that the required dividend is 6%. That can happen in Europe. And then we still have, let's say, overvaluation. If we put 40% on the normal case, a 30% on the best case, and 30%, then DHL stock is fairly valued from that risk and reward perspective when it comes to the situation now. Plus, if you look at the terminal value in 10 years, okay, it's still a little bit lower, but with all the dividends, it's hard to lose money if DHL doesn't go bankrupt or something crazy happens in Europe. But, okay, Europe is already cheaper than the United States, and therefore, here we have DHL, and for the first time, we have a positive ratio there of 1.09. The next dividend stock that we had was Schwab, the dividend ETF. I have already calculated the dividend, $1 per share compared to the stock price, and the required yield in the States now is 3.3%. So if they can grow at 7% as they did over the last 7-8 years since we made the analysis, then it is undervalued for that growth rate. You can get a 10% return. Very, very interesting. Best case, if somehow they grow at 9% going forward and then interest rates go down and let's say the dividend yield goes lower, then the stock price will go higher. Worst case scenario, let's say we have a few recessions, 3% dividend growth, and the terminal multiple goes to 4%, then the present value is 20 and the stock is overvalued. Let's put 30, 30, 30 here, as it is a pretty stable business and we cannot know interest rates going forward. There, the present situation, the stock price now is fairly valued, but it all depends on the growth. And here you have another fairly valued for a 10% return going forward, the 10% discount rate. So not bad at all. Something of value is there. We discussed these things. All right, let's do Google. If we divide the stock price with the P ratio, we get to earnings per share of 7.53. Google is a growth stock, therefore it will always be interesting to show how to calculate growth stocks here. Input EPS 7.53, and then how much will Google grow in the future? If we are conservative at 8% and then we put a terminal multiple of 25, then Google with that growth rate is still undervalued from that perspective compared to the current stock price. And that's why also I said in the video it will go to 250 all else equal. In the best case scenario, if we put 10% growth, then we are even at 280 from that perspective because of the 10% growth rate. In the worst case scenario, margin of safety, slower growth, and let's say the terminal multiple goes to 15, then yes, then the present value is much lower and the stock price goes lower. However, if we put normal case 33%, best case 34%, 33 here, then Google is another of fairly valued stocks. And if we get it here in our table, it is in line with the dividend here. But okay, the key risk there with Google, if we start not using search that much with ChatGPT, things like that. That's the disruptor, and that is also why Google is the cheapest of the magnificent 7 with a P ratio of just 25. But again, fairly valued for a 10% return. Okay, if we go to our quadrant, back to the quadrant, we have Petroleo Brasileiro, so Petrobras, the Brazilian company, and that is another dividend company. The dividend yield will not be 20 going forward. If oil prices go up, given the current situation, then it might be even 20. But their estimation is for a dividend of $1.75 going forward, thus a yield of around 13% going forward. Let's put that into our template here. So 1.75 dividend, we said, 1.75 payout ratio 100. Now I have to go back to Google and check whether I have dividend yield here. Sorry, that is the game changer here. Payout ratio is 0 with no dividends, or it's irrelevant, the small dividend of Google, and therefore that changes the intrinsic value, and we can put even what's there, 0.5% dividend yield, that's let's say 10% payout ratio. So that changes the game there for Google. And then if I go back to Google, we are here and it is overvalued. It was strange that it would be fairly valued for me. Okay, that's the change there. So I'll put Google and Petroleo in the same timestamp because it's necessary. Let's go back to Petrobras. They say for a pretty flat dividend because they are going to invest, so no growth, but a fat dividend. Terminal multiple is then, let's say 7 to get to the 13% yield on the future dividend also, if in 10 years the dividend is still that high. So the intrinsic value is 15 compared to the stock price. Best case scenario, let's say that they even grow the dividend 5% per year, and then that the dividend yield required is not 13, but let's say 7% or 6.5, then the stock can go much higher. But there is also the risk, no growth. Practically, there is also the risk that the dividend goes to 0. Let me try minus 100, so that you get nothing back, you get a few years of a dividend, and then you would lose a lot of the value, because if the government takes over because of the high debt or lower oil prices, then is that the risk. But if we put here probability, normal case, let's put 33, 34, 33, and then you see that depends on how you look at it. Yes, it is undervalued, but there is the total loss risk, which is something value investors don't take. So I will put it here. I wanted to use it as an example here. I'll put red here. It is cheap, but if oil prices stay low for longer, the government can come in, take over the company, sell the assets, things like that, which is a big risk given the debt levels, the production costs and everything. It's not like the company will disappear, just will be a new owner, which is what happens when it goes bankrupt. So a stock that we discussed here, and I have put it here as a lower risk, let's say good return stock to watch over time, is Archer Daniel Midland's 50 years of growing dividends. Dividend yield is now close to 4%, $2 per share dividend. And we have here, let's say, dividend per share, dividend $2 per share, payout ratio 100%. And if they grow at 4%, the dividend going forward, the dividend yield required by the market now is 25. So for a 10% return, and that's what I'm waiting for, hoping for, then I need the stock at around 40. The best case scenario, let's say that they grow the dividend 6% in a good food cycle. The market wants a 3% yield from them, and then the stock price goes to 60. So that is the upside. Worst case scenario, let's say they have just 2% grow dividend. They will grow the dividend because they had done it for 50 years. Inflation you got to eat. And then the market wants a 5% dividend yield. Then it would be a 30 stock price to see it undervalued or for a 10%, fairly valued for a 10% return. I'll put here 33, 34, 33, as I don't know for how long the food downturn will last. So maybe we'll get just an opportunity for this in the future, which will then give me a margin of safety at 30, which will then signal that this is then a strong buy. For now, if it is on the comparative table, we are close to a fair value of 10%. We are mostly likely at 8% now, given the good dividend and the potential growth, but that is already something. And now the sweetest for the end, Berkshire Hathaway. I have put it as a low-risk investment on my quadrant, but at also a lower reward because Warren Buffett went into cash, and I see Berkshire as a hedge compared to the market exuberance now. If we look at the market capitalization, 952 billion, the value creation is a little bit higher than 40 billion. Give it a recession, a little bit lower. Insurance, you never know, the reinsurance there with the fires now and everything. P ratio of 25, let's say 1 trillion, a little bit lower market cap, and growth in the future of 8%. Let's now put that into the calculation here. Let me just make it a little bit bigger. And we have now net income 40 billion, we compare it to the market capitalization. Dividend payout ratio is, thank you Warren, 0. Thus the present value of those calculations are not calculated. We need to see what will the potential earnings dividends be in the future, and that is what people are paying for. If they grow at, let's say, 6% conservatively, they get 5% on their cash for 5%. So that's already something, plus the dividends, plus the buying of the big businesses if there is a crash. Discount rate of 10, historical average P ratio 15 for Berkshire 10 years down the road. The intrinsic value for Berkshire in that situation, if you expect a 10% discount rate, is 390 billion. That's far from the current market cap, thus Berkshire is overvalued, exactly why Warren Buffett isn't doing any buybacks. Best case scenario, let's say 8% growth, then the market keeps the current terminal multiple of 25. If you want a 10% discount rate, it's not going to happen now with Berkshire, then the present value is still 770 billion. Likely the market, let's test with a 7% discount rate, that's it. The market expects good growth from Berkshire, the hedge size, and therefore it's willing to give it a 7% expected return, which is low for me and also for Buffett. Worst case scenario, 4% growth rate, let's say a terminal multiple of 12 or even 10, which happens for insurance company or happened for Berkshire when we made the video in March 2020, and then the present value is just 219 billion, but this is unlikely because just the cash and the businesses and everything, inflation, will likely give it a higher growth rate. And then let's put a 12 multiple. So just not priced for a 10% discount rate. If I put here 33, 34 equal situations there, then the valuation there is for 50% down would give it a fair value for a 10% discount rate. If I change the discount rate to 5%, then it goes higher and higher, 4%. Then we are getting closer to the valuation there. But also we need to change the terminal multiples to higher 20, let's say 30, and here 15, and then we get to the present value calculation. But let's stick to our guns. Let's remain conservative, prudent from a value investing perspective. And therefore, if we look at Berkshire here, compare it to the 10% return, sorry, you just connect it to the billions, and there you have it. We'll do a video about Berkshire when the yearly returns come out, and then we'll dig in detail, but very overvalued. That's exactly why Warren Buffett isn't doing the buybacks. I hope you enjoyed the extensive explanation of the intrinsic value. The template here, you can download it, you can ask me questions at investwithsvenkarlin@gmail.com. Thanks for watching, and I'll see you in the next video.